and just thank you so much for everyone coming here today after work and making the time to hang out. And really, I want this to be super interactive as well. So even though you can pop a question in Slido, if there's anything that you want to stop me and get some clarification, just raise your hand and just say, what does Series A mean, or whatever it is, and let's make it super interactive. I guess I want to understand the people in the room as well, so maybe a raise of hands who's an entrepreneur / founder in the room. Sweet, and who knows a bit about startups and venture capital already? Awesome, okay, cool. If there's anything new and stuff, again, don't hesitate to just call it out. But I guess just a bit of background. So I started my career off in equities research, actually a New Zealand super fund, managing some portfolio in the stock market, and started off as an investor. And I realized that it actually takes a lot to really understand the fundamentals of a company, and coming straight out of uni to an investing role was really difficult because I didn't really understand what made companies move the dial, how do you actually evaluate companies and things like that. So I actually left that job to join a fintech startup to automate my role in equities research. And so the startup experience was epic. We wrote code, we flew to New York, did partnerships and talked to customers and all that great stuff. And I realized it was so hard, it was so tiring to kind of do everything all at once. And I love that journey, and I fell in love with that journey. And I've always loved startups, but I did miss investing as well. So my journey led me to Blackbird. So Blackbird is a venture capital firm, and maybe I'll give you a bit of background as well as to how Blackbird got started. So in 2012, 2013, back in Australia, it got started in Australia by a couple of guys who just came back from Silicon Valley and really wanted to create that ecosystem in Australia, which really didn't exist. And back then, no venture capital virtually, but there were so many great tech companies coming out of Australia. So Atlassian and Aconex and Campaign Monitor and these guys, and they had to list really early or had to go to the US to get funding because they couldn't find private capital funding in Australia. And so a couple of guys decided to fundraise, and it took them 2 years and 500 meetings, and then they finally raised a 30 mil fund. But from that 30 mil fund, it was made up of 90 individual investors, which is massive, because a lot of institutional investors didn't really understand venture capital and return profiles. And so what they did, the founders of Blackbird, went out and raised from a bunch of tech founders who have already been there, done that, succeeded. So they raised from the founders of Atlassian, the founders of Aconex and Campaign Monitor. And what those guys did was not only bring capital, but they brought their operating expertise, they brought their networks that they leveraged all around the world, and they brought founder empathy. So they understood what it was like to be on the other side of the table, how hard it is to build a startup, all the kind of nights crying on the table, why isn't this working? Why doesn't anyone understand? And so all of that brought this really awesome community of founders who have gone before the next generation. And so what's really unique about Blackbird, and this is why I fell in love with Blackbird, is it's really community driven. And the people behind Blackbird, the investors, we're only a small part of it, but the value that we bring is around the founders who we've invested in and are giving back to the next generation and the next generation. So our motto is founders helping founders. So that's really about Blackbird. And yeah, I think, so today I'm here to talk about fundraising. So Blackbird is an Australian fund, but we actually just landed in New Zealand end of last year. I am a Kiwi though, and we raised a $60 million fund to invest in seed and Series A rounds in awesome Kiwi founders. And we're just getting started. We've made 3 investments so far this year in AO Air, and Partly, and in Multitudes, a hardware company and 2 software companies. And we are so hungry to find more great founders, and that's why I'm so excited to be here to meet all you guys and meet all potential founders and learn more about what you guys are doing as well. So, Blackbird, we lead pre-seed, seed, Series A. Typically, a check size is around 1 to 3 mil, but we do go as early as 200, 100K just to build the relationship with the founder, watch founders grow over time, and then we build conviction and we invest in more and more and more over time. So that's kind of our model. And we're here to supercharge the most ambitious Kiwi and Aussie founders. And we want to invest hundreds of millions of dollars into great companies. So a typical success story, the story that I love telling is the one with Canva. Canva, as you know, most of you guys may know, is a design software platform. And when they first pitched to us, we invested 250K into the company back when it was kind of an idea, some sort of validation. And 7 years later, we've invested almost $200 million into the company, $5 billion valuation, millions of users, really impressive growth story. And the relationship that we just had with them over time just blossomed. And I'm really hoping that today maybe is a start of a relationship that we can form with founders and continue to invest hundreds of millions of dollars into. Cool. So again, super interactive. I'm here to talk about fundraising, the journey, maybe break down some of the key rounds. It might be super basic for some of you guys, but this is investing 101, basically. Cool. So fundraising, there's a couple of different structures, but you can bootstrap, you can raise from family and friends, you can raise from angels or high net worths, and you can raise from venture capital. This is not in any order. Usually we see people that have bootstrapped along the way. You've seen some people that have raised from angels and high net worths before venture capital, or usually we've just seen people come straight to venture capital as well. And I'm here to talk about venture capital and what that means. So the difference between venture capital and all other investing is we raise funds as well from other investors. As I mentioned before, we raise from high net worths or institutions. And the benefit of raising from venture capital is if you're a high growth startup, you need a lot of capital to fuel your growth. So imagine starting a company, you have a few customers, it gets traction, you need to hire more engineers to continue to build out your roadmap and funnel into sales and marketing and things like that. So you need more capital than you can actually earn with revenue. So you raise capital so that you can have more money and hire more people. And so venture capital is great because you can have the ability to raise more and more and more from the same investors over time. Generally, startups raise every 12 to 18 months, and that's kind of like the funding cycle, which I'll talk about more later on. But venture capital just gives you that ability to keep fundraising more over time as well. Another awesome stuff about venture capital is we invest professionally for a living, and sometimes we co-invest with other VCs as well. And so we are able to bring that kind of connections to overseas co-investors. So for example, we co-invested along Sequoia with a company called Culture Amp, and through that we formed a relationship with them and brought them into another portfolio company, Propeller. And so we're kind of able to open those doors to go beyond Australia and New Zealand investors if you want to go global. And the last thing which I talked about at the beginning is the community. So bringing you community of founders and also talent. And there's heaps of really awesome Kiwi people coming back from overseas from their experience in the US, and they're looking for jobs. So giving founders connections to those really awesome people is what we do as well. Cool, and that's just, this is an old graph and this is an old slide, so apologies. So this was a 2017 graph that showed the rate of growth at which we invested in some of our top companies like Canva and Zoox. As they increase revenue over time, they raise more and more money, and this is pretty much the successful funding growth trajectory of some of our companies. Cool. So I'm going to break down the stages of fundraising, and not by dollar value, because this actually changes depending on which country you're in. So in the US, your seed is probably like a $5 million round, whereas in New Zealand it's like a 500K round. So I'm going to break it down by milestones and units of progress of what venture capitalists look for. So pre-seed. Actually, I was just thinking maybe we should like do a bit of a game where you guys shout out like a random startup and we can come up with some milestones together or something. But let me know if that's what you want to do. If there's anyone with an interesting startup idea, maybe you can put some examples to that. Maybe anyone brave? Yes.
So I'm working on an app that essentially allows people to automatically invest and save money. Kind of like Acorns in the US or Plum in the UK.
Okay, so is it when people spend and they like?
Yeah, when they swipe their card, yeah, it kind of like rounds up and saves and invests that amount. So when you swipe, say, for a coffee of $5, it'll invest, say, 10% of that, 50 cents towards an investment.
Okay, yeah. Cool, awesome. So Fintech app requires you to pay money, and so the thesis there is people want to save money, make it as convenient as possible, as frictionless as possible, and people will just, and you'll take the clip of the ticket of what they invest or something. And so the opportunity there, let's pretend that there's kind of no regulation or whatever, and then you can scale really, really fast beyond Australia, New Zealand. So the dream there is to be all across the world, everyone's spending, they're all saving for, was it for charity or for just saving generally?
No, just for themselves, because yeah, New Zealand, for example, just as an example, is the 4th worst in the world at saving. So getting into the habit without having to think and consume time towards making money decisions.
I have so many questions for that, because you're kind of forcing them to spend in order to save. So
yeah, I know.
It's like, buy this, 70k Tesla and save much.
Yeah. We've thought about consumerism. We've thought about it.
Yeah. Awesome. No, that's cool. Let's just go with that. So pre-seed stage. You're at pre-seed stage. You've got some sort of proof of concept, and you have some evidence that this idea works, whether it's you've talked to 1,000 people and they're like, we really need this product. You've maybe got some sort of MVP where you're not really integrated with banks, but you are kind of proving that people's spending habits equals meaningful savings. So you've got all those insights. And let's pretend that this idea is something that no one's really ever heard of, something new that other people haven't really thought about savings in that way. So what you have is some sort of evidence of learnings for MVP or proof of concept, and you also have some sort of earned insight into that industry that no one else has. So that's really exciting for VCs because we really want to learn about this cutting edge, something new. And so that's the pre-seed round. You generally raise, 400, 500K, you have to hire 3 engineers and 2 sales and marketing folks to reach to a certain milestone of maybe 1,000 customers, and that's what you're raising for. So you're kind of working your way backwards. How much money do I need? How am I going to spend it? Where are the milestones am I going to get to? And so that's a pre-seed round, and then the seed round, you now have evidence of learning from that first iteration. You've built this MVP, you've learned that people aren't really saving as much through this method, but you've come up with another different kind of core way of iterating on the product, and you know kind of now where to focus on. So you've got some evidence of learnings, you've still got your own insights, you've got evidence of customer love and traction, you've now got 1,000 people using this platform, actively using it every single day. So what we love to see is there is activity, user activity. That speaks so much louder than words than user signups or whatever it is. You want to see people really engage with this. So it's an indispensable product. Everyone is using your app. You've got some idea of a product roadmap. So when we invest, we're not investing in the products that you have today. We're not investing in what you've done in the past. We're really buying into the future. We're really hoping how investors make money is they buy more and more and more into the future as your valuation increases. And the reason your valuation increases is because your product becomes more valuable. There's less risk. So there's way more risk at the beginning because you don't have anything. But as you continue to build, you have more of a product to show for. You're de-risking it. Therefore, the price becomes more expensive and you can raise from more investors as well. And so at this stage, you're raising at a higher valuation, maybe a 5 mil valuation, whereas pre-seed, you're raising it a 1 mil valuation. And now you have a bit of a roadmap. So you now want to build out the functionality of, okay, not just savings, but actually you can do budgeting on this app. You can do other things on this app. And now you need to hire more engineers. Now you need to hire 8 engineers, 4 back-end, 4 front-end, whatever it is. And you've got some idea of go-to-market. So you know the niche. You find that, oh, it's actually the millennials that are using this way more than other generations. So now you have a clear go-to-market. You know where all the millennials are hanging out. You know where to advertise, Instagram, Facebook, or whatever it is. So you kind of have this more of a clearer idea than when you did at that pre-seed round. And now investors are getting really excited and like, okay, let's see your next milestones. And so you've raised this round, and now you're preparing for Series A. And so Series A, you've got everything that you've had before. So you've got some evidence of learnings, you've got insights, you've got customer love, and you've got clear kind of unit economics as well. And so this is a bit important because as with hardware or software companies, you have to have a clear understanding of what you're investing, what money you're putting in, and what you're getting out of that. So with hardware, it might be the cost of goods sold, you know, and the revenue. So you're looking at gross margins. And with software, you might be looking at sales efficiency, which is the cost of, you know, sales and marketing, for example, and the revenue that you get back from that. So how much does it cost to advertise on Facebook and Instagram versus how much money are your customers bringing in for their lifetime? So, you know, if it costs you $3 to bring someone in, but they only pay you $1 and they only stay for 1 year, then that's negative unit economics. That's not sustainable. And as you grow the business, you're going to plow more money into spending on ads and people are going to churn. So understanding a little bit more about that, how much you're going to charge people, how much of the value they're going to bring over time, how long they stay for. And then a clear idea of product roadmap. So now you've got your budgeting tool, all these other stuff, and then you want to expand to something else. I don't know, maybe now you're going to charities or organizations, maybe you're rolling it out in enterprise mode where you're helping Tech Futures Labs employees learn to save, all these other stuff, all these great ideas, and you're compounding and growing really fast. So here you have more of a clear idea of that and the go-to-market and hiring plan. And lastly, oopsies, oh yeah. I don't have a slide for Series B plus because that's massive scale and we're not really there yet. We're just taking baby steps for now. But I just wanted to talk a little bit about the fundraising cycle as well. And generally, fundraising takes 6 months. If you believe it or not, it takes a long time. It's a full-time job. You're constantly going out there talking to people, having meetings. If you are fundraising, expect to not move a dial for your product at all. It's going to sit there. You're not going to be able to handle customers and investors and all that stuff at the same time. And generally, it takes a month or so to prepare a pitch deck, which is the thing that you send out to investors for the first time, kind of introducing yourself. This is my idea. This is my summary. This is my concept. And so you really want to spend some time you know, thinking about how to clearly articulate your story. Pitch deck is literally storytelling, so hone in on that skill set, because as a founder, you will be telling stories all day, every day for the rest of your life. You're going to be telling stories to get employees to come on board to choose you instead of Rocket Lab or Xero, whatever you want to attract the best talent. You're going to be telling stories to investors to say, pick me out of all these hundreds of startups. You have to understand, this is my vision. And you're going to be telling stories to your customers, like this is my brand, this is my story, you can connect with me. So you have to be a really good storyteller to be a really good founder. And that's really just the truth of it. Like no one really talks about it, but you have to be a fantastic storyteller. There are some founders that, you know, raise millions and millions of dollars because they're great storytellers. Is their product better than others? Probably, maybe not, but they're just brilliant storytellers and they're able to attract great talent to build incredible products. You can't do it on your own as a founder. So pitch deck, a couple of months, and then expect to take hundreds of investor meetings, and that's going to take up all your time. You're really, you know, going out there, telling your story back to back to back to back, and it does get pretty intense, I can tell you that. And then afterwards, you've kind of narrowed down. There's some investors that are interested in you, you're interested in them, and now you're going to partner meetings. And what that is, you know, generally you meet a partner from VC, they have a coffee with you, they're trying to understand you, and then they bring you into partner meeting to meet the rest of the partnership and the rest of the investment team. So that's kind of you giving the same presentation as a pitch deck and trying to convince the whole team that they should back you. And then you've got the term sheet stage, which is, if you're lucky, you'll get more than one and you'll kind of pit them off against each other, who can give me the highest valuation. And the reason you want a high valuation, it's kind of double-edged sword, but high valuation means that you're less diluted, because as you raise over time, you're going to be diluted more and more. And so what we don't like seeing as investors early days is, you know, founders having 20% right off the bat, just because over time you're going to be diluted anyway. And so we really want to see founders really own the majority of the cap table at the very early stage. So yes.
What's a good way to kind of pit them against each other versus a bad way to pit them against each other? Like, what's some do's and don'ts there? Like, just sounds like.
That's I guess being transparent about who you're talking to, who's interested. Yeah. So what we've seen is great founders are really good at communicating who they're talking to, and some of the founders I respect the most are the ones that don't say yes straight away and then back out of a term sheet. Like that breaks our heart when we're like, we've signed it, yes, and then all of a sudden they, I'm going to go with someone else. So don't do that. That's the worst thing you can do. The best thing you can do is say, hey, just being transparent, I'm talking to X and Y as well. We're on term sheet stage. This is roughly the valuation. And I think I might be going with them, but I really want to go with you guys because you guys have the founder community, you've got the right network, and I really hope that, we can bring that up and just have a conversation. It's literally just a heart-to-heart almost of like, this is why it's important to me. And I'm sure we can kind of reach a certain level, but the ideal situation is finding an investor that has completely aligned value with you and can meet you on that as well, as long as your demand is kind of realistic.
I heard that in Silicon Valley that they recommend telling people that you're actually, have some competing term sheets, but not to say the name of the company, because that will actually, like, people call each other, and then they'll say, because they know VCs know each other and have a stronger relationship with each other than they do with, a founder.
Interesting.
Yeah.
I feel like in Australia and New Zealand, it's probably not there yet.
Okay.
Like it's probably not like.
That sounds way nicer to do that. Yeah.
Yeah, no, that's interesting. I feel like Silicon Valley is now, startups is now so productized. VCs are now sales firms. It's like, it's a completely different ballgame there. And I feel like we're still, New Zealand and Australia is so raw. And that's the beauty of it, is that we're also raw, still so naive, but we're also about the startup, the product, and not so much about, inflated valuation and all that stuff. So I feel like, yeah, to be honest, that the open, honest conversation is the best. And I've seen founders talk about, we're talking to XYZ firm and stuff, and we just have a conversation about it. Yeah.
Oh, I like that term.
Yeah, it's friendly.
Yeah.
About valuations, how does one arrive at valuation, especially when it's pre-seed?
Yeah, generally you just work backwards from how much you need to raise and how much you don't want to be diluted by. So, for example, for us, we'd like to get like a 20% ownership if we were the lead investor. So let's say you're raising 200K, we invest the whole 200K, we want 20%, so the valuation is $1 million. And the founder has 80% ownership, and it's super simple. We're not going to kind of do multiples and all that kind of reverse engineering stuff. It's based just how much you raise, dilution. Valuation is not that important. Term sheets, and then final legal docs, which is most of my day today. I'm almost like falling asleep. I'm so tired of reading all the subscription docs and stuff. Lawyers, man. And then, and then wire transfer, yay, and then you're done, like 6 months. Oh my God, I can get back to product now. So what we love to do is just get the founders to wrap it up as fast as possible. So they go back to hiring, now they've got funding, they can get an office, they can hire people, and that's the celebration. But really, building a great enduring company takes a long time, and VCs want companies to take the biggest shot possible. Our incentive is to grow the company to be the Googles, the Teslas, whatever it is, and that takes a long time. And if you're a founder that's looking for a quick exit, then that doesn't really align with our 10-year fund timeframe. So what we're looking for are founders who are doing this because this is their life's mission, it's their life's purpose. And companies like Canva, they're a $5 billion company now, but I'm sure they'll be $50 billion in like the next couple of years. And so the ability to kind of grow bigger and bigger makes us, that is the perfect type of relationship. And so when founders come to me and they're like, we're going to exit in 3 years' time and it's going to trade sale for $30 million, like, that's not exciting. Like, exciting is Canva, $5 billion, Canva like, changing the world, like, that's exciting. And so it takes 8 years plus to build a great business. And during that time, you'll be fundraising, building company, fundraising, building company. So again, startups raise every kind of 12 to 18 months. And really, building the company part is the most important part, and fundraising is just enough to fuel the tank so that you get to the next stage of your journey. So that's how you should think about fundraising. It's not, the product. Selling assets, selling your securities, selling your equities is not the product, but selling your product is the product. So it's what I really want to keep reminding founders, that just focus on the products. And so what do VCs look for? Just taking a look at my slides. Huge ambition. Again, we have a 60 mil fund, New Zealand fund for Blackbird. I'm thinking that's roughly think if we invest $5 million into a company, that's 12 companies, 12 opportunities, got 12 shots. I feel like an M&M here, like rapping. So with my 12 shots, I really want to make them count. And the reason for that is this is an old graph, but this is like VC incentive in a graph. It shows that we raised 30 mil about 7 years ago, and in 2017, today's much bigger, but 2017 it shows these individual blocks are companies that have grown, and then there's 17 other companies on top. And these three are the ones that we're looking for. They're the unicorn, the one that more than returned the fund. So that red block is like worth more than the entire fund that was raised. And so when you're thinking about the companies you want to invest in, the 12 companies, like each of them have to count to be those big ones, because so many fail. So that's why, you know, when I'm deciding between a company that, you know, has an opportunity this big, that's then focused on New Zealand, they want to grow in New Zealand, versus this big, you know, they're global from the outset, they're already selling, a huge traction, I'm going to naturally gravitate to the company that has a huge ambition. And that's why ambition is so important for us. And that's the end of my slide. So yeah, I'm happy to take any questions, and yes.
So, just wondering what the kind of I guess environment is right now, like especially if you're doing like B2B, like, you know, there's B2B kind of software kind of, and are people reading the room and not really trying to launch during this time because, you know, people's houses are on fire? I'm just wondering about the, you know, the time, because I just keep hearing over and over again, like in VC podcasts, that timing is everything. So,
yeah, I mean, it is timing, and if it's not the right time to launch something, then you have to kind of think twice as to whether this will be a headwind for you or a tailwind. Like, ideally, we want something that's a tailwind. And right now with COVID, with climate change, all these things happening, there are so many problems that provides tailwinds as to why we should start building problems that will ride with the next generation of the fundamental shift. So if this product that you're talking about is something that the environment just doesn't need or want right now, what's the point? You know, what's the point in doing it now? Maybe it's time to think about something else, or, you know, shift to the new way of working and just really adapting really fast. And so, like, you know, most of like some really awesome companies like Airbnb and Uber and stuff came out of global financial crisis, ride sharing, people were sharing things, and now COVID, people aren't sharing things, they want their own things. So it's kind of like, you know, adapt with the times and really ride the tailwind, try to make those fundamental shift a tailwind for you, not a headwind.
A question from Slido. So this is from Shane. What percentage of equity are VCs likely to want in a fresh startup? So I think you touched a little bit on that 20%. Maybe you want to expand on how you guys arrive at that.
Yeah, so 10 to 20%, sometimes 25%, but a sweet spot I think is around 20%. The reason for that is we want to keep investing over a long period of time. In the next round, if you guys are doing really well, we do this thing where we invest in our pro rata shares, which means that if you guys are raising, we have the ability to keep investing to maintain a 20% ownership. And for us, it's kind of about back calculating, if we exit in the next 10 years time, how much money do we need to have in order to make a meaningful return on our fund? How much will we be diluted by? And, you know, 20% by the end of 10 years might be diluted down to 15% or 10%. As you're raising at a higher valuation, we need to put in more and more money. Sometimes we don't have enough money to invest in a $50 billion valuation, so we get diluted massively. So just starting off with like a 20, 25% is a decent chunk, so that over time we're not too diluted.
The next one is, it's quite a specific question, although it's had 5 votes, so obviously there's a bunch of people interested in it. And the question is, what would your advice be for fundraising as a pre-seed fintech startup? So the example over there.
Pre-seed.
So the question there is around, I guess, a regulated space with a lot of costs in that. How do you view those kind of tricky spaces?
I think with Blackbird specifically, the reason we haven't really touched fintech is because of the regulation. And again, if you look at it as a trade-off between a company that can scale globally from the outset, that can move a lot faster, versus a company that's, you know, headwind by regulation from day one, the other company is always going to scale a lot faster. And again, thinking from the 12 shot, like which company are you going to go for? So for Blackbird, we have not been investing in fintech because of that reason. But then again, I think definitely talk to the Australian banks who have venture capital arms. They love that stuff, and happy to introduce you to some Fintech Aussie VCs as well.
Next one was, do you have a sector in mind when you're looking for a business? So do you tend to go after a particular sector, or is it more general?
Yeah, so we invest across sectors, and it's interesting because when we first got started, every single company, except for one company in our portfolio, was all SaaS, like software. 2012, like most people didn't even understand what SaaS was. Like Xero was like valued at really ridiculously low, and now SaaS is becoming a lot more popular. People understand what SaaS is. We still love SaaS, but there are lots of other opportunities that are coming up for the next generation of wave as well. And the thing about VC is that you can't be stuck on a particular trend. You have to always keep reinventing, learning, and really keep up with what's happening next. So like remember in the 90s, it was internet, 2000s, social network, marketplaces, 2010 SaaS, 2020, there's so much more going on. I think one area that we've been interested in is in synthetic biology. So we've invested in kind of alternative foods, like lab-grown meats. So there's a company called Val that we invested in, and they grow meat in a petri dish. But the awesome thing that I love about Val is that they're so creative. And you see there's so many companies in Silicon Valley growing, like we're gonna make beef and we're gonna make pork and duck or whatever it is. But Val is taking all these different cells from different animals, reconstituting and creating the perfect protein for individuals. And so that's such a unique concept. It's so incredible, like meat that, Galapagos turtle or whatever it is, just like all these different types of meats. And so like synthetic biology is super interesting. We also invest in space as well. We invest in consumer products. We invest in, so many other things. So in New Zealand fund, we invested in software and also Freightfish, which is a hydrofoil shipping container, autonomous shipping container. So that's transportation. But the main kind of underlying thing is around technology enabled and also ambition. And so although we invest across a lot of different things, we look for technology enabled and the ambition of the founder.
Well, I've come to these events. Who would have thought hydrofoil shipping containers? There's a company presumably in New Zealand doing that. It's amazing. So
yeah.
You talk to people when you come to these events, you hear about these interesting things, fascinating. So changing tack a little bit, in terms of actually working for a VC firm, so the question was, what do VC firms look like for hiring? The question was specifically, how can they try to get more experience in the VC interest as an intern? But I guess maybe just generally, who works for a VC firm? What kind of people come in there?
Yeah, I love this because from experience, having worked in the finance industry and then in a startup, I can hand to heart say my experience in the startup ecosystem was so much more valuable. I had to unlearn some stuff that I learned in corporate finance, but with startups, you really build founder empathy by actually being being there, doing that, and most of what we do is working a lot with founders and really understanding when times are tough, you're kind of the first port of call. Sometimes you have to sit on the board, and having that empathy to actually understand what it takes to build a startup and how to set milestones and being okay with them not reaching milestones and having those tough conversations. That is like a really important chunk of the job. So for anyone who wants to get into venture capital, I would say go and get founder empathy, go and build your own startup, see how bloody hard it is, so you can actually have that experience of knowing what it's like. And then founders tend to gravitate towards people that understand as well. And so that's kind of the competitive advantage. And most of the people at Blackbird had that startup experience, and the community that we have are all founders. And so that's kind of the back door into these things. But also we're hiring. So Blackbird, it's just the New Zealand team is myself and our partner Samantha Wong, and we're hiring for a community manager, and we're probably looking for an analyst or a principal or something like that by the end of next year. And interesting fact is, VCs aren't that ambitious. You know, like the VCs itself, they go out and say, hey, founders, you have to be really ambitious so they can make me a lot of money, whatever. But VCs themselves, like, you know, once they get their big payday, they're kind of just like on a yacht or whatever. But the other thing that I love about Blackbird is that we want to be ambitious ourselves. And so we've started off in venture capital, but what we envisage the future is that we want to keep holding on to these amazing big companies when they IPO and when they get bigger, and kind of, you know, our ambition is to be like Berkshire Hathaway or Bridgewater and those guys, and just really be an investment powerhouse. And when I first started, we were kind of like 8 people, and 2 years later, we're now 30 people, and by the end of next year, we're going to be 40 people. And so that's a growth rate you don't really see in venture capital, but I think our ambition is bigger than VC as well. So if you're interested in that kind of growth path, let me know as well, and I'll let you know when our roles come out.
This is also why you speak at a product tank event, you get to advertise the role.
Yeah.
One of the benefits we give our speakers. So yeah, changing taking a little bit of a different direction. Silicon Valley episode immediately springs to mind. First one is, how open should you be with VCs about the ideas that you've been working on? Should we insist on a signed NDA before opening them out?
Oh my God. Idea is like 1%. Execution is 99%. And you've heard that before because it is so true. You can have ideas, shower thoughts, whatever, or just like a slide deck or whatever. It's so easy to do that. The hardest part is actually putting it to plan, hiring people, making it happen, talking to customers, like building the product, learning to code, all that stuff. So never ask a VC to sign an NDA. We see the same stuff so many times, and so we can't not talk about it within the team. And if you say, hey, sign an NDA, I'll probably say, good luck. Like, I mean, it's really not about protecting the idea. The way that you grow something is to share it and to tell about, you know, this is what I'm doing. And then what we'd love to do is connect you with the right people to help you grow that idea. So be open and share as much as possible, because if someone was to steal your idea and go and create it, you're going to have that problem anyway in the future. So if you can't outpace them, then you should be doing it.
Well, I'll combine a couple of questions here, and this is actually a question that came from me, and this was what actually the genesis of this talk, is I hear a lot from product managers grumbling about, you know, how the idea is just the founder or the owner of the company going, well, we're going to build that without actually doing any validation in market. So you spoke a little bit about it in terms of what you're looking for at those various stages. Can you maybe expand a bit on what you're looking for in terms of validation of the product? What does a validated product look like to you?
Yeah, so it depends on what industry you're in, but validating pretty much means that you're not rocking up with some McKinsey graph saying, hey, this is a $10 billion market. Here are some unvalidated assumptions. I haven't even gone out and tested myself, but, you know, some internet reports said this. Now give me $1 million and I'm going to go build it. Because it's just, that requires zero effort. And that shows us that you're not willing to spend any time on this to go out there and prove it for yourself. So why should we spend any money on this to prove it for you? So what we want to see are people that have done a lot with a little. So the company that I talked about before, Bao, which is the lab-grown meat, those 2 founders, before they even raised money, went and got government grant funding, $40,000, built and created I think it was duck or something in the lab. And just that one product would take millions of dollars in Silicon Valley. They did it in 40K. They hustled their way into free labs. They hustled their way into getting that all done. And then they came to us and said, hey, we created this, and, you know, this is our roadmap. And if they just came to us with the idea and roadmap, it doesn't show their ability to execute. But the fact that they came to us and said, hey, we did X, Y, Z, and we had no money, just show that they had so much creativity, so much conviction, that it makes us really, you know, we want to invest in people like that. And so, you know, it doesn't have to be super fancy MVP or whatever. It's just showing that you can go out there, build something quickly, show that there is customer love in this niche. Just validate that there is some sort of, you know, interest in it. When you build it, people will come and buy it. Like, that is what we want to see. And so that's kind of like the bare minimum of what you should give to VCs to get excited about.
This is a kind of a related question. Do you look out for founder product fit?
Founder, yes. So what we call that is someone's life's work or life's mission. And the thing about that is, when you start a startup, you're going to hit so many brick walls. There's so many exit paths where you can just say, I give up, I don't want to do this. But if you have a personal affinity, like I want this to be solved. So for example, we invested in a company called Overa, and the founder, she has terrible period pain. So she created this device that sits in your stomach, and her research was that vibration signals moves faster to the brain than pain signals, and so it overrides pain signals. And so when you stick this on the stomach, you will no longer have period pain. And for her, the pain was so excruciating that she's just, she passes out. And so that was the motivation, that's the fire inside her of I need to create this product because this needs to exist, because there's so many women like that out there, like me, and I need to solve this problem for them. And so when her factory was shut down in China, or when her shipping didn't come through, or whatever it is, she pushed through, because the pain of not having the product be created versus the pain of pushing through was so much higher. And so just that whole life's mission of this is why I'm doing it, this is why I will never give up, and that resilience really ties together nicely with the life's work. And that's kind of the founder product that we look for.
There's two questions here, and I kind of feel like they're related a little bit. So the first one was, how do you see COVID affecting the VC space in the next 12 to 24 months? And then the second one was, how do we get investments while working part-time in our startup? And what these two things are
Really? So the getting investment, working part-time, I think it depends on everyone's situation. Sometimes you have a family, you need to work part-time, but as long as you can show that you do have the conviction to go full-time once you've raised, or you're not just doing this as one of many other things that you're doing, it's kind of going back to your life's mission. Like, is this something that you want to spend the rest of your life doing? And if you can leave work and spend your whole time doing this, why haven't you done so already? So we want to see people working full-time on this if they can. In terms of COVID changing landscape, it's just another one of those fundamental shifts where people will now be a lot more cautious about health and safety. Maybe there's something in that as a trend. There's a lot of articles and reports going around about how it's changing the future of work. There's a lot more people working online now. It gives way to kind of more products around measuring productivity, collaboration, all this stuff. So there's so many different ripple effects coming out of this, and it's really exciting. And I really want to meet a founder who has some sort of idea in the space. Yeah.
Cool. Questions around minimums. So what's the minimum dollar value that you've invested in a business, and what's the minimum percentage of return that you invest on your investment you're looking for? So rather than thinking about the maximum, what's the lowest you would go before you go out?
We don't think in minimums. We're in the business of to the moon, and that is the ambition right there. Like, if you're thinking minimum, you're already failing as an investor. So our promise to our investors and why we do this is because we want to back the companies that are best in the world. So we don't think in minimum. In terms of the minimum check size, we have written, it was 65K actually a couple of weeks ago, and that was just to get our foot in the door in this very oversubscribed round. And we usually don't do that often. The earliest that we've gone is around kind of 100 to 200K, and that's just if the founder just wasn't ready to raise a lot, they just really want to prove out something, we're happy to write a smaller check just to get them to get some learnings and some lessons.
You mentioned earlier around target funding and dilution factors being the sort of relating to the number that the companies are looking for.
Oh.
And so that was your comment about the calculation of what the valuation of the company is. Sort of start with the 20%, and then how much you're looking to dilute the founders by. But the question is I thought valuation should be based on the potential growth of the company, i.e. future sales and growth.
Yeah, it depends. So really early stage, it's really around kind of just the two factors of how much you're willing to raise, how much are you willing to be diluted by. And if you're in a competitive market, there might be some kind of valuation benchmarking going on. When you get larger and larger and larger, your ability to sell the story of the future that you're trying to build can actually lead to higher multiples of revenue. So in terms of like software, we think of in terms of multiples. So a lot of companies benchmark themselves against public multiples, which is 10 times revenue. So that's, if you're making $100 million in revenue, then your valuation is $1 billion, you're a unicorn, and that's why everyone's so obsessed with 10 times earning revenues. But if you're a great fundraiser, you can kind of talk about how you'll grow faster than the average benchmark. And when you think about valuation, you're thinking about how long will it take for them to reach that 10 times benchmark. And if you're able to raise at like 30 times benchmark, and it takes you less than a year to get there, then it's de-risking it for us. And you tend to have more leverage if you are a larger company that have proven track record that you can actually get there. But you don't really have that much leverage when you're very, very early stage or raising for the first time. And also when you're raising for the next round, investors are going to look at what you've done in the past, going to look at whether you meet the milestones, have achieved what you said you will achieve. And if you haven't achieved that, then you're going to have a tough time kind of negotiating, like, I deserve a higher valuation. It might not be justified.
The question is, how does a startup seek funding? So where do they start? So do they rock up to you and sort of go, hey, Tip, I'd like some money?
Hey, Tip. I mean, like, that's why I'm here. I mean, what I'm struggling with being in New Zealand is, like, I want to meet the founders who are under the radar, who might sometimes not show up to a typical startup event, but might show up to a product event because they're a product person. And so, definitely reach out. Like, that's why we're here. That's why Sam and I moved to New Zealand, so that we can be face to face and meet founders. And if you're not a right fit, we'll tell you that you're not a right fit. And if you are, then, you know, like, there's so many opportunities. So just, there's my email address.
Questions from the floor? Let's jump into line.
So the 12 shops, how many founders, how many different companies did you talk to get that to that 12? What's the ratio? Roughly.
Thousands of pitch deck equals 1 to 2 investments a year. So I can see thousands of pitch decks. I can take, you know, tens of meetings a week, and then kind of bring in 2 to 3 or 4 meetings into the partner pitch section, which is bringing them to an entire team, and then maybe make 1 investment. So the funnel is huge, but the level of people that we meet is smaller, and the level of investments is even smaller than that. So the hard thing about venture capital is you meet a lot of great people, but you rarely say yes. Like, it's really hard. And, you know, most of my days I have to say no to people, and I'm a bit of a people pleaser as well. So every time I'm writing a rejection email, like, I'm so sorry. It feels so horrible. But I mean, as a founder, you have to put yourself out there, and if it's not a right fit between us, you'll have to find investors that believe in your vision, and that's a much better alignment in the long run as well.
So about 1,000 to 1, roughly.
Probably. In terms of pitch decks that we see, we get like 10, 20 pitch decks coming in almost every day as well. So yeah, there's just kind of different inbound opportunities and stuff.
And I guess to riff on that a little bit, do you have a process that you can, that's such a huge volume of stuff coming in, and there's 2 of you, how do you manage that volume?
Yeah, I think that's kind of across Australia and New Zealand as well, and our team is larger than 2 of us. But once you kind of see, like, and have the ability to know which ones that, you know, even just people coming through our website and the way that they answer their application, and the level of ambition or the relevancy or what we're looking for. Since we have very strong values, like, we're looking for certain things, well, we can kind of cull very fast in terms of, like, that's a yes, that's a no, that's a yes. But most of the time, like, most VCs are wrong, and we're going to miss really great opportunities. And we have a Slack channel called Anti-Portfolio, which is all the opportunities that we've missed. But that's just the reality of the game, because there's just so much deal flow that naturally you're going to miss a couple of awesome companies. And you can always look back and say, oh, what if I did that? But it's just the hard truth.
And I guess maybe related to that, do venture capitals team up to invest in a business if it's such a hot thing? Do VCs get together, or is it usually going independently?
From Australia, New Zealand, generally it's driven by the founder, and depending on the stage as well. So early stages, driven by the founder, who they want their cap tables. What we did recently was we invested in the company, and we left them a small round to open up to other investors as well. And we made some introductions for potential angels that they want to invest in. So we do try to bring in other investors, especially kind of early stage angel investors who can add value to the business, not just bring capital. And in the larger stages, when they have trouble kind of filling up the round size, or when we know that there are great VCs who bring great expertise or some sort of value add, or have some sort of expertise in this area, or a community we want to tap into, then we bring them in as well and make introductions. And it's really up to the founder who they want to invest. We'll never impose and say, hey, you must have these guys on the cap table. End of the day, it's up to the founder.
Sorry, hand up.
Yeah, I have a question about your competition. What are the options in regards to venture capital firms do we have in Australia and New Zealand besides Blackbird?
So for New Zealand, if you go into my LinkedIn, I actually open sourced all the investor information. So you'll see a bunch of, so this is probably more relevant to you guys because most Australian VCs can't invest in New Zealand. And maybe it's worth touching that the reason that we actually opened a New Zealand fund partly is because there's a lot of great New Zealand investors, founders, but there's also tax regulation in Australia that stops us from investing too much of the fund into international companies. And New Zealand is international for us. So what that means is that we're capped at like 20% that we can't invest in over international companies. And we want to save that for Australian founders based in the US, UK, whatever. So the reason we opened a New Zealand fund is to solely invest in New Zealand companies. And so, yeah, if you go on my LinkedIn, there's a link on there that is open source New Zealand venture capital investors, and you'll see all the names and the email addresses. Everyone on there is open to you reaching out to them, and you can also filter by industry and size and stuff like that as well. So that's just a resource to use.
So, because I had looked at through your LinkedIn, so you previously mentioned working in the Australian market. So I was curious about how do you see the difference for the VC market here in New Zealand compared with your previous experience in Australia, and what is your kind of next big field focus, major focus here?
Yeah. So I grew up in New Zealand, in Christchurch, and I moved to Auckland to the big smoke because I thought there was more opportunity here. And I left New Zealand because I thought that there was more opportunity overseas. But actually, sitting at in the Sydney office and seeing the amount of deal flow and the incredible Kiwi founders coming through our door, I was like, holy crap, like New Zealand is the next big thing. New Zealand is the next big wave. And there's a couple of things going on. So firstly, we're seeing really awesome companies like Rocket Lab, like Xero coming up and incubating the next generation of founders who have seen what it's like to grow from 0 to 1 to 100. And they've got that experience in scaling. So the company we invested in, Frankfish, and also partly, they're ex-Rocket Lab people, ex-Halter people, and they've been there, done that, and now they're creating their own thing. And so I think New Zealand coming back here, like the opportunity is like enormous, and that's why we have so much conviction. That's why we raised $60 million. We think we're going to deploy that in the next 2, 3, 4 years. And so, yeah, New Zealand's the focus. If that answers your question.
Yeah.
No.
Yeah, I'm just curious about Blackbird. Are you guys only be like in the round, and you guys only be the lead investor, or you are also be able to do some like full up, like what kind of are you guys do full up basically?
Yeah, so we want to invest as early as possible, but if there is an awesome opportunity, and there is one really awesome opportunity that we're looking at right now, and the round is like a $15 million round, and usually that's kind of very, very big for us. We will make it work. We've got a follow-on fund, which is an Australian fund, and that's the one that's not subject to the tax regulation. It's only subject to the early stage. So we've got this follow-on fund that we can kind of split across as well. So we've raised $350 million for follow-ons, and that's to invest in existing portfolio companies. But if, for example, the round is really big and we can't fill it with the New Zealand fund, we'll supplement it with the follow-on fund. So we've got that capacity, but it's not often. We have to have super high conviction of something that's, you know, going to go from 15 mil to $1 billion, and that's the type of return profile that we're looking for. And the larger the company is at the initial stage, the harder it is for us to get that type of return that we're looking for.
Okay.
How do VC value like early stage startups that intend to generate revenue through selling ads?
One of our partners says, I hate ads, so you're probably not going to raise from us. It's the same, it's the same. How much money do you need to raise? Who you need to hire? How much are you going to be diluted by? And that's kind of how you work backwards. But the interesting thing is, so when I first joined Blackbird, I joined as a portfolio analyst, and I spent time not with early stage companies, but looking at what makes our larger companies successful. Like, what are the top performing SaaS companies, software as a service company, have in common? And one thing that we found was a certain growth trajectory that they kind of all follow, which is the triple, triple, double, double, double. And what that means is SaaS companies have recurring revenue. So think of Spotify charging $12 a month over time. And so annual recurring revenue is how much a customer pays to have that product. And generally it takes around kind of 18 to 24 months to reach the first $1 million. And that's already really, really fast. But if you have a viral SaaS product, that's how fast they grow. And then the next year, they triple that to around $6 million, and then triple it again to 18 million, and then double, and then double, double. And so that trajectory leads to $100 million in over just 6 to 7 years. And the reason why we love $100 million is the rule of times 10, you get $1 billion company, ARR, $100 million times 10 equals $1 billion valuation. And that's why VCs are so obsessed with unicorns, but they do kind of follow that trajectory, whether it's Slack, Zoom, Canva, all those companies, they have that kind of natural growth curve. So that's kind of what we found. And also another interesting insight was that all the great companies have this really awesome thing in common, which is they spend almost all of their initial fundraise in the very early stages solely on product, not on sales and marketing. And the reason for that is if you have an awesome product, you're going to get some sort of inherent virality. People are going to talk about it. They're going to say, hey, you guys come and use this product. And then, you're going to collect users pretty much. But if you have a shitty product and you're spending a lot of money on sales and marketing, you're going to get this leaky bucket effect where people come in, they're like, oh, it's buggy, oh, it's bad. I don't like this. And then they churn. And then that money that you spend on sales and marketing, it just goes away, and that's not sustainable. And so what we found was that great SaaS companies spend so much money in product for the long term to make the product awesome, to make it inherently viral, so that when people come, they spread through word of mouth. You don't actually need to spend money on sales and marketing, and then you get this natural growth effect. It's just one random thing.
Do you target particular markets or segments? For example, coming to New Zealand, we're going to go after agri or biotech.
Yeah. Everything.
What comes to you?
Everything. So we invest in Sunfed as well, which is an alternative protein. You can see the local Woolworths countdown. It's Woolworths in Australia. So the local countdown, and that is a consumer product. And generally people say like that's not technology, but the technology is actually in the way they process that and created that meat. So what Sharma, the founder, did was she used yellow pea protein and used a method where she reconstitutes the texture by using just water molecules. So instead of having a bunch of additives and all that bad stuff, which is all the Beyond Meats or whatever they use, she just uses pea protein and water molecules to create a process that replicates the texture of chicken strips. So that in itself was so unique, and her way of thinking was, to have a healthy alternative meat product is what the market needs right now. People don't want to just not eat meat because they're saving the planet, but they also want to be healthy. So this is another alternative for them. And so just that insight, that earned insight, was what got us excited. But yeah, every industry, except for maybe regulated fintech.
Do you require the company investing to be Delaware C Corp? Because a lot of VCs, especially overseas, require that.
What was it? Sorry?
Like, do you require New Zealand companies or whichever company investing to be a Delaware C registered Corp? Because a lot of VCs overseas require that. Even Canva, I think, is a Delaware C Corp.
Yeah, no. But I think generally when New Zealand or Australian companies flip up, so flip up means they become a US incorporated company. I think Delaware C Corp's quite friendly, so it's like the easiest process, and that's what they tend to do. And the reason you want to flip up is maybe you've grown, your majority of your customers are in the US, so you want to raise from US investors, and so they can't invest in, you're a foreign entity, so that's why you flip up to be a US company, and then they are able to invest in you.
No, sorry. Y Combinator just suggested that even if you're international, just to do a C Corp to start off with. Would you recommend that? Or?
I don't know. As a New Zealand company, probably don't need to. And for us, actually for us, we would like the company to be a New Zealand company because we, having taken money from the government, they also have this clause where a certain percentage can't be I think it was like 20% maximum for international companies. So that means that if you're a Kiwi founder, but you're incorporated overseas, it's kind of like, well, we've just wasted that 20% on something that could have just been a New Zealand company. So that's our preference, but I don't think you need to be a C Corp straight away.
How do you deal with a founder that may be sitting on multiple ideas? You know, we're talking about Elon Musk in red.
Yeah.
How do you deal with that? Or have you come across them?
Yeah, but it's kind of to the point of life's mission. It's about, there's a great podcast that we interviewed one of our founders, Tim, the founder of Eucalyptus, and he said you have to earn the right to have a place in this world, and you have to kind of prove that you can do one thing really, really well to earn the right to do the next thing. And so if you have a lot of ideas, it probably doesn't help to spread your energy all across it unless you're kind of A/B testing of whether this is a certain direction I should be going, and you're kind of doing that at low cost. But you know, if you're saying, I'm going to spend 50% of my time on company A and 50% of my time on company B, now I'm going to raise for company A. Like for us, we're just looking at what, like, why don't you have conviction in company A? You know, again, if we're going to spend 12 shots on you, like, why aren't you 100% in company A? So it's kind of harder for us to get that conviction.
How do you deal with an Elon, is what you're saying?
Well, Elon did PayPal, and then he did Tesla, and then he did something else, and he's earned his right to do all these things from the not from the beginning, but by proving that he can do.
That's the key to it. Yeah.
So it's just about at the top of the hour, so we'll wrap up with catch one more question from the room and one more question from Slido. So I'll start with the Slido one. This is talking about that. So VCs are looking for a proof of concept before investing, but it takes funding to create the proof of concept. How would you advise a company in that sort of chicken and egg kind of situation?
It depends. So like the example with Val that I mentioned, they got government grants, they did a proof of concept, which would take millions of dollars for Silicon Valley companies to do. It really depends on how creative you are and how you're willing to go out of your way to show that someone loves this product. And if you can't do that and you expect us to invest in you, why should we believe in your ability to be able to execute if you can't figure out a way to make show some sort of customer love, even if it's just going out and talking to 1,000 people and sharing your earnings, even if it's, you know, we invested in 2 PhD students who created this vascular monitoring system. So they scan people's veins to monitor whether there's cavities in the veins and predict if you're going to get heart disease. And those 2 PhD students didn't raise any money. They went around and scanned a bunch of people, pulled together some, you know, used some university products and followed cardiovascular surgeons around and was able to kind of network their way into it. It just shows founder creativity and ingenuity, and that's what we're looking for. And you know, you can say like, hey, it cost me money to build an X-ray machine or ultrasound machine, and I'm not going to sit here and do it unless you pay me. Like, we're not going to pay you. Like, we're going to go to the PhD students who have done it, who have proven themselves, and you know that they can do what they said they're going to do.
So one more question from the room. Some hands up over there.
So what's Blackbird's view on investing spin-offs that come out of universities and research institutes?
Yeah, that's a good one, because I think in the US, like university spin-offs are a lot founder friendly, so they're not kind of taking huge chunks of ownership, or they're not charging huge royalty fees. So what I'll be looking for if you're a university spin-off is, do you have IP? And if you're licensing IP from the university, like what does that contract look like? Will you eventually get ownership of the IP, or will you be forever paying university like a ridiculous amount of royalty fees over year on year, just because that's impacts your like cash flow and stuff as well. So ideally would love to invest in more kind of university spin-offs, but it really depends on how founder friendly the IP is.
Cool. Thank you very much, Tip. I'll just call on Tari, who will close us